Everybody, live from Singapore and London. Night in Singapore and it's afternoon in London before the Fed does the next move. So, what do we have for you today? Essentially, what does the market have for you? Lots of things. Number one, really on everybody's head is Trump won, and Trump won decisively. We will show you in the graphics today one of those maps that show where he won. Is in red for the Republicans and blue for the Democrats. But as one of my friends says from the FT, they should have done it in orange. It was a sweep. The man came back from the dead, so to speak, or from being shot or something, and he won decisively. He won the presidency, the House, and the Senate. He essentially has the power to do what he likes. I am sure he will be heavily challenged in that road he's embarking us on. And being challenged is not a bad thing because out of competition, out of everybody. So competition is good, being challenged is good. Here we at the officials and at Onyx, we like to be challenged because that's how the best comes out. So what's happening? Number one, of course, many people were not expecting the outcome that happened so decisively, but it did. And this means a few things are clear going forward. Number one is a lot of this semi woke, shall we say, and green initiatives are dead. Trump is going to change the line of travel for those things and is going to do things more based on economics. I belong to a group of people that are a little bit long in the tooth and like to talk about things and observe what other impacts are going to be. And one of the things being discussed is a change at the top of the IEA. The IEA has been supporting a lot of the green initiatives, and some of the people in the group were even wondering if the IEA should be reset to Texas and away from Paris, where it currently is. This is the type of change that could happen. The other, and this is very important to us all, is if Musk becomes the head chopper of heads, because the federal government is, as another of my friends calls it, the blob, something that needs to be reduced in size to then help reduce the budget deficit. If all of these things happen, of course, the US economy is going to blossom. It will accelerate. And this means oil demand, by definition, will go up. Those are the good things. The bad things are the tariffs. If Trump has his way, he'll put a tariff on anybody, even perhaps people like me coming to the US. Maybe we'll have to pay more to get in there. All those things are bad for globalization. And that means that maybe oil demand could come down because China won't be exporting as much as they can. And talking to our in house traders, they foresee less demand for plastics, less demand for metals, less demand for all these things that China is consuming to export to the Western markets. Because at the moment, the whole world is trying to tariff each other. That's very bad from an economics point of view because one should do what is good at. And China is the factory for the world. I'm just coming back from there and I'm now in Singapore. And what I have seen in China is, again, I was in Beijing, is a road to the EV. Everything is pointing towards that direction. And the skies are relatively clean, really bright. So they seem to be doing some good things regarding the environment. But their economy is definitely slowing down with a major caveat to share with you. The stimulus by the central government seems to be well accepted in the financial community. So stocks have been going up, some commodities are going up, and the question among the Western economists is how long will this last? So you have on one side the US maybe recovering, and on the other one, or accelerating in its recovery, and on the other one, maybe China finding its footing and coming up. These two things together could be very powerful. The weak partner in this relationship is not the global south. The global south is also doing well, but the weak partner is Europe. And we saw today, or from yesterday, essentially the fall of the German government. They have been killing themselves trying to, I don't know, reduce production of electricity or make it more expensive. And without electricity, nothing industrial happens. You need to focus on these things. One of the topics of discussion we have had after seeing the amazing development in China is that China produces more than twice the amount of electricity the US produces. Forget about Britain or forget about Germany. They're small boys, really. The big things are happening between the US and China. And China is far ahead in terms of production of key stuff. And definitely electricity is one of those key elements. So I continue to be surprised by the impact of the stimulus. In the initial reactions and readings we had, there were even internally within our house some people that were very bearish and said this will amount to nothing. But what I am seeing doesn't point to that. One of the impacts we have had is a lot of demand from the INE crude contract. So that resulted in retail buyers coming in, buying a lot of something that perhaps they don't understand, but never mind. When you buy something, the price goes up. And this opened the arc from the Middle East into the INE delivery points. So China is definitely lifting the backwardation and the demand for barrels from the Middle East. And of course, when Trump won, initially the market, in our opinion, read it correctly that over the long term, if globalization suffers, demand for crude will suffer. And initially the market got sold off, but now is already essentially $75. We'll see what happens later in the day when the Feds come out with their new interest rates. But already Britain cut interest rates by 25 points. So all these things could actually result in economic acceleration. But I want to pass it to Will, who tracks the macros into more detail. So please, Will, share your thoughts from London with us. Thank you.
Absolutely spot on, Jorge. Germany in particular is looking very weak. So we got two data points recently. We got industrial production, which came in below consensus of 1% at a 2.5% month-on-month contraction. This implies a 4.6% decrease year on year. So in the industrial centre of Europe is really flat on its back. And you know, I wonder really if all of the political turmoil that they're going through at the moment will help at all. I mean, I'm pretty sceptical. What do you think, Ed?
Yeah, I mean, if a government is going through this mess where the Green Party's leaders have resigned and then the other coalition members are making these pages and pages of demands, and now finally there's a no confidence vote in January, that's not going to help anything in the economy, really, that kind of a mess that they've got in their politics.
No, exactly. And one thing that we also tend to follow quite closely is construction. And construction PMIs, again, remained deeply contractionary in October, down at 43. A little bit less contractionary than the month prior, but still very weak. But really in the macro space, all eyes are on the Fed today. Currently, 23 bips is priced by the OIS. So it's not looking particularly likely that we'll deviate from that. It'd be a bit of a surprise if they either held or went larger. 25 bips seems like the central case, and that looks likely. But the interesting move has really been at the back of the OIS curve. So the market is now pricing less aggressive cuts from the Fed under Trump, especially at the long end of the curve. The yield curve initially responded to Trump's victory pretty aggressively, and we had a strong bear steepener in the curve with 10-year treasuries jumping 18.6 basis points. So, that has a real impact on the economy. That immediately affects mortgages, immediately affects the money that people can spend in the broader economy. But interestingly, unlike recent increases in yields, this has finally been driven in part by market-based inflation expectations. So 5-year break-evens jumped 15 basis points on Trump's announcements. So with more inflation expected, it's really looking like the easing cycle is going to be prolonged. We'll probably get 25 bips this time, but don't expect 25 bips every meeting. Yeah, it's worth mentioning as well that the OIS has priced around 100 bips of cuts by August 2025. If you were to go just a month ago, the OIS was pricing 140 bips. So that's how much the market pricing of interest rate cuts has come in.
Let me interject a little bit. If we add all this up, it almost sounds like one should buy the stock market in the US, should buy the stock market in China, and sell as much as one can out of the European stock markets, doesn't it?
Yeah, for sure. And I mean, we've already seen a little bit of that portfolio rotation. So we've seen a bull steepening in the yield curves in Europe across all the core sovereign debt markets, as people are piling into those shorter end sovereign bonds after liquidating their equity holdings in Europe.
Yeah. And I also would like to point out to some of our predictions that have been spot on. From our earlier episodes, we shared with you our belief that small equities would go up, the indices representing the small cap. Prior to just sitting down with you here, I saw the performance of small caps on a year-to-year basis, and they're up 35% in the US. It's like, wow, if you put your money there, you are enjoying those returns. So I guess one should buy small caps, big caps, American, of course, and one should buy Tesla and all these things. They seem to be on a run. Of course, nothing runs up forever, whether it's stocks or oil or gold or anything, but as of now, it looks healthy. The Chinese market looks healthy, but Europe, it really gives me belly aches because I grow there. Now, turning to Ed, the Saudis announced some price decreases. What do you think about that?
Yeah, so as you mentioned, the OSPs came out yesterday, and the Saudis have cut their OSPs into Asia. Into Europe, they've increased them slightly by about 30 cents on most of the grades, but then into Asia, they've all been cut. So the light crude, the light Arabian crude has been cut by 50 cents. It's more or less what we were expecting. And we've been tracking, since we began the officials, we've been tracking the physical premium of Dubai partials. So in the window, we've been obviously assessing the Dubai markets and then coming to an assessment on the physical premium paid for each of these partial transactions. And in September, that averaged $2.08. And that's come off pretty consistently on an average basis. Into October, it came down to $150. And then into November so far, just the first 5 days, but it's come down to 70 cents. So the backwardation in the Dubai structure has really been easing. So you've got to ask why. Is that a sign of responding to weakness in China, which perhaps is now going to recover slightly? As you say, the stimulus is potentially going to see a recovery in the Chinese demand, as you outlined at the beginning. So I think the OSPs are interesting, but perhaps they need to respond to the cautious optimism we have in regard to China.
Okay. I talked to some of the Saudi customers today, and the Saudi price cuts came in within expectations. Some people had from 30 to 60 cents decrease, and essentially, depending on the grade, they came in on target for Asia. But coming in on target based on the performance of Dubai, perhaps is not coming in on target to what the customer wants to increase consumption of those grades. So I met some of them that were not ready to nominate fully, but actually were decreasing month on month the crudes. They think it's too expensive and that the market, including Canada, offers better options to buy. So never forget, in every market is a fight. It's a fight for the consumer and it's a fight to the producer. And right now, it seems that Saudi Arabia is targeting its joint ventures to dispose of the crude and maybe doesn't care as much about the incremental buyer. And the buyer, well, can find something elsewhere. So, how do we sum everything up? Well, we have been very bearish for a long term, and prices briefly hit the 60 oil mark. After traveling in these areas twice in a row, structurally, some markets look bearish in the long term. And I want to share something very important with you. The EV transition is happening very fast. More and more vehicles are sold. There are still concerns about the stability of the batteries, whether they catch fire or whatever. But hey, we didn't see a fire anywhere. I think those things were happening more in the past. But what is interesting is, and we'll publish something about this data, in China, it costs about 15% is the cost that it would cost you to travel the same distance if you do it on an EV versus oil. So you save about 85% of the cost if you switch to EVs. We have also seen that change in the Middle East, where my Emirati friends, white robe, very much oil people, they're also buying EVs because since electricity is cheap, it's a lot cheaper to run on EV than to run on subsidized gasoline. Imagine that. So EV is a revolution. Get ready for it. It's really, really happening. And this will cause many markets to switch into other areas and create new ones. We are there to let you know what happens and to share with you everything in the market. So with that, folks, thank you very much. And we'll be ready for whatever the Fed will announce. Thank you.